Hope everyone's doing well and had a good day. This is the Emini review for Wednesday, June 26th, 2024. So we'll take a look at the daily chart first. If you look at the past few days, we had an outside bar on Monday and an inside bar yesterday, Tuesday. So coming into the day, I thought it was unlikely we would have another inside bar today. It's rare to see an I pattern, so inside, outside, inside, and then another inside bar. So I thought at a minimum we would test and break out of yesterday's high or yesterday's low. And if we did either one of those, because it's an inside bar, you hear me say it all the time, intraday, because price action is fractal, it doesn't matter the time frame. Whenever you have an inside bar, the probability of a successful breakout is lower, it's reduced, because it's a trading range. It's range compression. And if you zoom in on these daily chart bars, even though they have, like Tuesday, looks like a bull trend bar, big body, small tails, but when you look at the bar intraday, you know it's a trading range. So I thought sellers above and buyers below yesterday. And overall, likely to go more sideways. It's Wednesday, so we're halfway through the week. If you look up here, the weekly chart, you can see we have a doji trading range. The bar's around its midpoint, and the bulls and bears are fighting for control over the bar. The bears are hoping to get as strong a bear bar as they can get to disappoint the bulls. Maybe bulls exit below the bear bar. And the bulls want the opposite, as bullish a bar as they can get, and a bar that bulls will buy below and bears will exit above. And then for the 5-minute today, we gap down on the open, and bar one's a doji bar. It's a buy reversal bar, closed above its midpoint, but there's probably sellers above bar one. Not a very strong buy signal bar. It's a trading range bar. And we know there's sellers above trading ranges and buyers below if we go there. I want to mention the rally into the close of yesterday was also fairly strong. There was a small pullback trend within a trading range, of course, but this was strong enough to expect a trend line break should lead to a retest of the trend's extremes. So I do think we'll go higher. Bar 2 triggered the buy above bar 1 and immediately reversed down. So it's a bear reversal bar, but the first two bars are really trading range bars. So there's probably buyers below bar 2. It's a low one after a trend line break, but again, we're expecting a retest of the bull trend's extreme. And overall, if you just look to the left, you know the market's in a trading range. Where's bar 1 testing? Well, we had a bad buy signal bar 42, or rather bar 43 yesterday, and that's what triggered the bulls on 43 or on 44, and we rallied, and we're getting close to it. And that bar is a magnet, the hive bar 43, because it was a bad stop order signal bar. And so you had bears, tight channel, bears are selling above, they got trapped. Bears are scaling in higher, looking to exit at this price. Three is an inside bar, so more sideways, more trading range price action, probably buyers below and sellers above. We did have a gap down, as I mentioned, so I think the gap down, you can imagine it as a bear trend bar. It will function the same way as if it's a bear trend bar. Gaps and trend bars, breakout bars, function the same way. And so I think there will be a second leg after that gap down. So probably sellers above bar 2 and sellers maybe at the moving average, maybe at the close of yesterday. I also think it's helpful, it's worth mentioning this, helpful to look at the, actually I won't go there yet, but I want to talk about the Globex chart eventually. 4, going higher, it's a bull breakout, good for the bulls, but we're still completely below the moving average, and it's possible bar 4 is 2 legs up. We rallied on 1, pulled back, rallied up to bar 4. And the bears are going to use any pullback to short, and the bulls who were long got trapped on the gap down. They're going to use any rally to exit their losing long positions. So the upside might be limited. The bulls need follow through. And then the bulls do get follow through, but it's minimum follow through. We tested the moving average and found sellers at the moving average. So even though bar 5 is a bull bar, it closed below its midpoint. So it's about as minimum gets for breakout follow through. Bull breakout 4, the bulls need a bull close. Well, actually, what the bulls need for minimum follow through is the absence of a bear body or a bear bar. And so this is it's an interesting bar because it closed with a bull body, but technically it's a bear bar, closed below its midpoint. What about selling below bar 5? Low 2 short, low 1 on bar 2, and then low 2, bar 5. Well, bar 5, more likely a low 1. We didn't trigger a low 1 below bar 2. And it's a tight enough channel. It's a micro channel since bar 1. So the odds are there are buyers below bar 5. Not a strong sell signal bar. And bar 4 was strong enough for a second leg up. And then it got follow through. And then 6 triggered the sell. Stop order sell below 5, but not a good stop order sell, which means it's a good limit order buy. But then bar 6, it wasn't the greatest entry bar for the bulls. And what bar 6 became is a high 1 signal bar. But it's a high 1 signal bar with the trading range signal bar. So not ideal, probably sellers above for that reason alone. It's completely below the moving average, following a gap down. And it's possible we rally for maybe 3 legs, up on 1, pull back, up to 5, pull back, maybe one more rally. Probably sellers above 6, maybe above bar 5, and at other resistance to the left, like breakout points below any of these bars. Before I forget, let me draw the high of yesterday. So high 1, bar 6, but not ideal to buy. And then 7, a bull reversal bar closing on its high. So if you're a bear and you shorted the high 1 with a limit order, you're disappointed with your entry bar, bar 7. It's a bull bar closing on its high. It's still a fairly tight channel, but now it's technically 2 legs up. Leg 1, pull back below 5, leg 2. But with bar 7 being a bull bar closing on its high, disappointing bears, limit order bears selling above 6, it's probably going at least a little bit higher. Probably test the 60-minute EMA, that's the dotted blue line above. And the bulls are finally getting just the first close above the moving average of the day. So we went a little higher on bar 8, but it's disappointing. And whenever I use the word disappointing, you have to assume the market's in a trading range. Disappointment is the hallmark of a trading range. Every time we have a breakout today, bull breakout and then doji, disappointing, sideways for 2 bars. Bull breakout and then sideways, disappointing. So if you're a bull buying breakouts, you buy above the breakout bar 4 or 7, you're pretty disappointed with both entry bars. At this point, it's possible we have a parabolic wedge. And the shape, it's never perfect, but you can see 1, 2, 3 pushes up. So we're getting to a point where the upside might be coming very limited. You think about, we have the gap down, expecting a second leg down. And then we're testing the close of yesterday. We're getting close to it. We have a doji on bar 8, trading range bar. So less traders willing to sell below, but traders will sell above. And as far as buying below the bar, it's not ideal because it's after 3 pushes up. But it's still tight enough that if you looked at a different time frame, a higher time frame chart, this is probably just one bull leg, a simple leg with no pullbacks. 9, we trigger the stop order sell below bar 8, but bar 8's a trading range bar, so buyers below. But again, not ideal. So the bulls, if they're buying there, they're buying for a scalp and they know it. Bar 9 closed on its high, but it's a small body. And then bar 9 is a high 1. But the problem with high 1s in this context, and by this context I mean a trading range, is that if you're going to buy a high 1 in a trading range, you want it to be at the bottom of the range. And you look at this overall chart, you know we're in the upper third of the trading range. We're also in an area where bulls got trapped, so we're in a sell zone, a resistance area. We've had 3 pushes up, so it's a dueling lines pattern. You have breakout points here, bulls buying below bars got trapped, we're testing it, parabolic wedge, there is a bull trend line, the bulls are hoping that holds, and we just rally straight through the resistance, but we'll have to see what happens. The bulls have to do something pretty special with bar 10 for this high 1 to convince traders we're going higher. And then look at bar 10. So if you're a bull and you bought the bar 9 high 1, are you excited about your entry bar? No, of course not. Again, you're disappointed. So that tells you the market's in a trading range. And if the market's in a trading range, think about what we've had over the past 10 bars. We've had a bull leg in a trading range, lots of overlapping bars, a couple of decent bull bars, but bad follow through. And then I will say, one thing the bears are lacking is selling pressure. The bears have one bar 2 in 10 bars. All the other bear closes, if they are bear closes, are dojis. But again, the problem with bar 10 and the overall context for the bulls is that this might be a wedge and a test of resistance. We know that on the open, 50% of the moves, like breakouts on the open, 50% of them reverse. And that's why I want to bring up the Globex chart and look up to 1020. Because it's always good to have an idea of what the Globex looks like coming into the day. And I said we're going to look at 1020. So here we are. So look at this rally, and then look to the left. You know when you look to the left, this is a small pullback bear trend. It's really strong for the bears. You can see lots of bear bars, very small pullbacks, if any pullbacks at all. All the bars below the moving average. The price is moving down in such a way that's parallel to the moving average, so it's not climactic. It became a little climactic here, and that's why we're pulling back. But do you really want to buy up here? Probably not. What's happening is we have a trend line break, and that's good for the bulls. So here's a bear trend line. Clearly, we broke the trend line. But if you've been studying Al, you know how the market typically operates. You get a minor reversal that can be fairly big, but the expectation is not bear trend into bull trend, especially when the bear trend is as strong as it is here, and the rally is as strong as it is here. So more likely what we're looking at here is a bull leg in an overall trading range. It's hard to say this is still a bear trend after this much buying pressure, but the reality is for the bulls, it's fairly weak. Lots of overlap, dojis, big down, big up, bars below the moving average, bars above. The market's going more sideways now. So what happens? The bulls know that, so they're going to take profits. The bears know that. They know the first reversal, it is a trend line break, but we're still expecting a test of the bear trend's low. So we'll have a combination of bulls and bears selling. You add that to the fact that we have 1, 2, 3 pushes up, and after every buy signal, bull trend bar or bull bar closing on its high, it's being met with a disappointing entry bar. That was what I wanted to talk about with the Globex chart. Is it necessary to look at the Globex chart? It's not necessary, but I got that advice from, I think I got it from Brad. And I know Al's talked about it. I think it's always good to be aware of what the Globex session is doing coming into the day. And that just means, briefly look at what the market's doing. It doesn't mean you have to trade with the Globex session to your left. If you prefer the day chart, I do prefer to trade with the day chart to the left rather than Globex. But again, just good to have an idea. Just glance at the Globex session. see what the market's been doing, and it can be useful. And you would have gained some pretty important information coming into the day, which was we have a small pullback bear trend. So is this rally going to lead to a big bull trend? And of course, probably not. But again, the reason it's not necessary is you can come to the same conclusions by looking at the day only chart. We had a gap down. We're expecting trapped bulls above. This is a resistance area, probably sellers above, and expecting a second leg down. Plus, look to the left. Overall, the market's in a trading range. The context is more sideways. So no matter how you look at it, you're not expecting this to just go on and on. It's more likely a bull leg in a trading range. Outside bar on bar 11. So maybe 3 or 4 legs up for the bulls now. We're testing the close of the prior day. Outside bars are trading range bars, expanding triangles. The market, we had a small bar on bar 10, small trading range bar, and then range expansion. The market might be in breakout mode. Probably sellers above. I don't think I mentioned trading range bar here, so the odds were sellers above bar 10 and maybe buyers below, but the context doesn't really support it. It is a trading range bar after a bull reversal bar closing on its high, but context always trumps everything. So if I had to choose between buying below bar 10 or selling, I'd rather sell, even though this happened. Outside bar 11, and like I said, probably breakout mode. We're testing an area where bears are looking to sell. Bulls and bears both looking to sell. Bears trying to get in for shorts. Bulls holding losing positions, scaled and lower. They're going to exit as well. So we're expecting a second leg down sometime soon. And you think about the market cycle and the leg count, we've already had probably 2 or 3, or rather 3 or 4 legs up here. And then 12 was a little bit of a surprise bar. And I mentioned this in my prior video, and it's just an analogy that makes sense to me. But bar 12, I say it's a surprise bar, but it's the type of surprise that you get when there's a jump scare in a horror movie, where it's kind of like you see it coming, and it really makes sense that this happened. Now, it is a big bar. It's an unusually big bar, but when you consider the market behavior, you consider this was all the event. How's the market going to respond? What's the response? Everybody sells. 12, a big enough surprise, big enough bar. It's a big enough breakout. You can expect sellers above, and you can expect a second leg down. But because it's a big trend bar in a trading range, Brad calls these emotional bars, and they're really sell climaxes. They're sell vacuum tests of support. We're testing the bar 3 high. That was a breakout point. Got tested a couple times on 6 and 7, but it never closed. It's still open, and then 12's coming back down to test it again. And the problem with 12 being a big bar in a trading range, the expectation is 1 to 3 bars sideways. You have bears who sold above, looking to take profits, and you have bulls who recognize it's an overall trading range. We're getting a test low in the range, so they'll buy, scale in lower. Inside bar 13, probably buyers below. It's a bull trend bar, but it's an inside bar, so trading range. What about buying above bar 13, double bottom? I would not. Bar 12 is just so big, and the odds are any test higher is going to lead to sellers above. You have a breakout point. You have several breakout points. The bar 9 low, bar 11 low. Any bull who bought anywhere got trapped on 12. So any bounce, if you're a bull and you bought anywhere, say you bought here, and this was what happened, you're going to look to exit on any bounce if you're lucky enough to get there. And that's the logic behind breakouts and second legs. You also have bears who didn't sell. We have this huge breakout. They're looking for a pullback to sell as well. So 13 might be the start of that pullback. 13 is a strong enough bar. It'll probably get its own small second leg. And we have to test higher before the second leg. That's also common in trading ranges. You get these breakouts, and then you get deep pullbacks before a delayed second leg. Bear bar 14, we triggered the low one short below 13, and we bounced, failed breakout below, which is expected. Now we've had 2 bars sideways. 14 is the bare minimum second leg for the bears. 1 leg down on 12, pull back, second leg, testing the close of bar 12. But the reality is, this could all just still be 1 leg. The market, the geometry of the markets like order and symmetry. And so, is bar 14 a symmetrical second leg? Of course not. Bar 12 is much bigger, and so this might just be a pullback of the pullback. Remember, markets are fractal, and if you break it down far enough, you would see this more clearly. But the way I see it is we have a bear breakout, and then 1 leg up for the bulls, a pullback, probably a second leg up for the bulls before a bigger second leg down that's more symmetrical, similar in size as bar 12. So what do you do with bar 14? There's probably sellers above and buyers below. It's a low one where if bears sold the close of 12, disappointed 13, they're exiting here. That's contributing to the bounce on 14. And then 15, you can see we sold off a bit and then rallied. 15 is a micro double bottom. So what about buying above 15? I think it's okay to buy for a swing, but the reality is 12 is still probably going to get a second leg. So if you are buying, the upside might be limited before there's a second leg down. 15 is a strong enough bar, and it's a micro double bottom that bears might exit above it and look to sell higher. So you might have bulls buying for scalps and bears exiting shorts looking to sell higher instead. And then 16, we had a bull breakout crossing the moving average, good for the bulls, but look to the left. Still, we're within the range of bar 12. Bar 12 is like the mother bar. All the bars, 13 through 16, are within the range of 12. And overall trading range, we're testing high in the range. We're testing higher to where bulls got trapped. And this is an area where both bulls and bears are looking to sell. Strong enough up on 15 and 16, it'll probably get its own second leg. And if it does, we'll have 1, pullback, 2, pullback, 3 legs up to the top of a trading range after a bear breakout that was strong enough for a second leg. So the upside might be limited, and if you are long, you have to manage the trade quickly and wisely, because being long up here can be dangerous. 17, another bull bar, but notice the tail on 17. That's the second leg that I was talking about. Strong enough 15 and 16 for a second leg, but it's a micro channel. How is that a second leg? Because if you go to a lower time frame chart, you see the tail on 17. We rallied on these bars, pulled back, and then rallied again. It could even be nested 2 legs, or like I said, even 3 legs, maybe 1, 2, 3, or here's leg 1, deep pullback, leg 2. And remember, this is a variation of a major trend reversal. Here's a bull trend line break, retest of the trend's extreme, expect sellers, disappointed bulls above, and bears who missed the trade looking to get short as well. And that's the logic behind double tops. It's like I mentioned when I was looking at the Globex session, bear breakout, you can call it a bear trend. And then this, disappointing, big down, big up, big confusion. This is a minor trend line break on the Globex session. Small pullback trend. The rally broke the trend line, but we're expecting a test of the trend's extreme. I also forgot to mention, and this is a supporting factor as well, that the odds that bar 1 remains the low of the day is about 20%. And if bar 1 is going to remain the low of the day, you want to see this be more bullish. You want to see a bull trend day or a fairly strong bull trading range day. And so far, the bulls need to do more. And so at this point, we're waiting to see what happens at the retest. But there's a couple of reasons why I think we're going below bar 1. And then 18, we had a bull breakout above the bar, and 18 reversed and closed near its low. Double top with bar 12. Good sell signal bar, and as hard as it looks to sell after 3 consecutive bull bars, it is possible that it's 3 legs up. 1, 2, 3. And then it's a double top. Context supports a second leg down. Here's leg 1. Complex pullback, maybe a second leg. Plus the bar 1 fact, the stat behind bar 1. We may have to get there before the buyers come in. 19. The entry bar for the stop order sell below 18. I was hinting that I think bar 18 is a reasonable stop order sell. And if you took that trade, 19, not your dream entry bar, but what's the flip side? If you're a bull, are you looking to buy above 19? Probably not. If anything, bulls just got trapped. If a bull bought the close of 17 and they got trapped on bar 18, bar 19 did not retest the close of 17. So bulls are currently trapped. There's probably more sellers above 19 than buyers. What about buying below 19? I don't know. You can make an argument for it. This is a trading range. This is low in the range. But the reality is we're probably going lower, and this may be the start of a second leg down. 20. Bear breakout bar. 3 consecutive bear bars, probably sellers above, and probably going at least a little lower with the momentum and with the context. Overall trading range, may have to test the bottom of the range. The bottom of the range could be here, somewhere in here, or down here, or even the low of yesterday. I also think we're testing this red line today, which is the bad buy signal bar, 43 high from the prior day. What do you do here? It's okay to be short, but you have to know that you're selling in an area where bears just got trapped. This might be support. But again, 3 bars down, strong enough, we're probably going to get a small second leg down at least. And then instead, 21 just sold off. And look where 21 tested this red line, the bad buy signal bar. And look where the market tested. If you're at this price, what did the market do the last time it was at this price? We rallied in a small pullback trend. So do you really want to sell down here? Probably not. Overall trading range, we're low in the range, testing below bar 1. There's buyers below. So that's the problem with being short. If you are shorting, you have to get out quickly. We probably fell for a measured move of this bar as well. And it might be hard to see, but that was the exact measured move to the tick. So a couple reasons to expect support there, and the market reacted to it. So what do you do here? 4-bar micro channel, do you sell above? Well, there's a couple problems. I think the context, again, it always goes back to context. The context isn't great, even though usually you get a 4-bar micro channel, there's probably more sellers above. But, and even context besides the point, if you inspect the strength of this breakout, here's a breakout, and then we pulled back. So this already might be 2 legs down, and then here's the gap down, and then a second leg. The second leg subdivided into 2 legs, and then just one more. It's possible we have 1, 2, 3 pushes down. Might be a wedge bull flag. Here's a bull trend. We had open gaps. Now we're getting sell climaxes. 1, 2, 3, testing support. So not ideal to be selling here. One more thing about the way I'm drawing this wedge. Elle mentions it all the time. It's pretty common you get the first push down before you get the last high of the bull trend. So even though we had a new high after this high, and this is where the first push was, you're really just drawing swing lows. 22, a strong bull trend bar closing on its high. That bar is a problem for the bears for a couple of reasons. The first one, if you are a bear selling above bar 21, betting it's a 4-bar micro channel, should be sellers above and a second leg down. If your entry bar is bar 22, you're automatically disappointed, and you might just bail out of the trade right there and buy the close, buy above bar 22. 22 is also, we have a breakout mode opening today. Market might have a double bottom, might be a wedge with including prior day patterns, and then we have a bull bar closing on its high. 22 is an always in flip bar, and so even here it's 2 legs down, low in a trading range, not ideal to be short. Then you get this bar, it might be always in long. You can argue the bulls need one more bar, but either way you probably have bulls and bears buying above bar 22 and then follow through buying 23. So at this point you have 2 consecutive bull bars, at least one being big, closing on its high, probably always in long. And then the problem with buying the close here is that the market's in a trading range. So bull breakout, and it's leg 1, it's strong, that's all true. But look to the left. This is a resistance area. You probably have more sellers here, but the resistance is probably minor. This is strong enough for the bulls that there's probably buyers below, and we're expecting a second leg up. Where are the buyers below? I mentioned the bar 21. Limit order sell. Bears who sold here, they got trapped. So if the market lets them out here, they're probably going to take it. Maybe they scale in higher, look to exit at this red line. Inside bar 24. But the fact that it's an inside bar reduces the probability for breakouts. So probably buyers below. There might be sellers above, and we might get a more complex pullback before the second leg. And the reason there's buyers below is, like I mentioned, you have bears trapped here, strong enough bull breakout, bulls and bears below the market looking to buy for that second leg. 25 tested the breakout point but did not close it. The close of 25 did not close below the open of bar 21. So right now the gap is still open. You have bulls, you can see the tail on 25, bulls and bears buying. And so at this point, this is a breakout pullback, and we're expecting a second leg to the upside. And then a bull trend bar, 26, might be the start of that second leg. We rallied, pulled back, trapped bears, and trapped bulls, you could say. Bulls didn't buy above the bad signal bar, so we're testing it. And now we're rallying on 26. Decent bull trend bar, closing just above the moving average. And it's an overall trading range. So we have maybe 3 legs down, and we're expecting a couple legs up, maybe to test high in the range. And then we have this leg 1 breakout. We're expecting a second leg, so we're probably going to go higher. 27, a bull bar closing on its high. The reality is there's probably more buyers above, even though the context doesn't look great, probably high in a trading range. But this was strong enough, again, for a second leg. I said the market likes symmetry. Here's that, leg 1, leg 2. You can see we stopped. We closed around that leg 2 measured move. And then here, maybe you use the tails like this. The minimum the bulls are looking for is here, testing near the close of 17. That wasn't quite right, huh? There, that's better. So maybe that's leg 1, pull back, leg 2 to a new high in the overall trading range. You can also use bodies. Everyone uses different prices. You can use just the tails of the bull bars, put that on the tail of this bull bar, and that brings you to the high of the day. Bull trend bar 28, 3 consecutive bull bars, decent bull breakout, but 2 legs up, high in a trading range. So some bulls might be looking to take profits here, but we have that measured move target above, and we're probably going to test the high of the day. It's probably going at least a little bit higher. 3 consecutive bull bars, might be by the close. And remember, this might be the high of the trading range. This might be the high of the trading range. We're not sure yet. And then 29, a very climactic and big bull trend bar. I used to get trapped on bars like 29 all the time, where I'd see the market's going up, it's going up and up and up, and finally we get this big, clear bull trend bar. consecutive bull bars, both closing near their highs, it's time to buy, right? That's what would trap me all the time. And just look to the left. And the reality is that you look to the left, the market's in a trading range. What did the market do the last time we were at this price? It fell all the way down here. So do you really want to buy here? Probably not. You know, if you study AL, that 80% of breakouts of trading ranges fail. So as strong as this looks, and it is pretty strong for the bulls, but you have to ask yourself, how much of the bar is actually breaking out? We're breaking out of the trading range from this red line to here. And I don't even know, maybe 5% of this rally. So not ideal. The bulls still need follow through. And the reality is it's more likely a profit taking bar for the bulls, and it could easily be an exhaustion gap and a second leg trap. Second leg traps are common in trading ranges. And then 30, a disappointing bar. So there's that word again. If you bought the close of 29, you're disappointed. So what are you going to do if we retest the close of 29? You're probably going to exit. 30, a trading range bar with a bear body, probably sellers above. There might be buyers below, but it's a bad location, high in a trading range, so the bulls might step aside, look to buy lower, and the bears might start to sell. Inside bar 31, it's a high one. There are probably more sellers above. We're at the high of yesterday, and you can see the market failed to break out. There's probably more sellers above 31. 32, it's a non-strict outside bar. It functions exactly the same way. We tried to break out above and below the prior bar. It's breakout mode. High 1 above 32, but the context is bad. It's after a strong looking rally, but again, the breakout was maybe a couple points, maybe a few ticks above the high of yesterday, and then it got no follow through. And it could easily be leg 1 and then a second leg trap, probably sellers above 32. 33, it's again the high 1 signal bar. We're getting lots of legs down on a smaller time frame, and it's becoming a little bit of an endless pullback. If you're a bull and you bought the close of bar 29, you're saying, okay, if I buy here, I can probably scale in and exit at my original entry. But after 4 bars, you still haven't got there, and you've had 1 bull bar. You can argue 2 with bar 30, but the reality is you've had really bad buying pressure in the past 4 bars. So if you're a bull, for lack of words, you might be feeling nervous if you bought here, and this is what you're getting, probably sellers above. And then it's an inside bar, it's another trading range bar on 34, probably sellers above. And the problem with buying below is we're still high in the trading range. Context is bad, probably going lower. This exhaustion gap, we have a breakout point here, probably going to get here at a minimum. And then 35, bear trend bar, not especially big. Bulls might try to argue wedge, bull flag on a smaller time frame. We rallied, sold off for several legs, looked to buy for a second leg up. But again, the context is not very good. And look at the buying pressure in here. 6 bars without a decent bull bar. It's not good. The bulls might give up below a bar like 35. 35 might even be the start of the give up for the bulls. 36 rallied, tested the close of 29. Did not quite get there, I don't think. 41 in the high, 41. So we got there to the tick. So if a bull bought the close of 29, they might have been lucky enough to exit at their original entry if they scaled in. But that's exactly what bar 36 is telling you. Why did 36 rally and then sell off and close below its midpoint? It's because this here disappointed the bulls. And so that means this is probably strong enough for a second leg down. Not the strongest looking bear breakout, but it is a micro channel since bar 30, and the bears had time control. 6 bars without the bulls controlling the market. So deep pullback, probably get a second leg down. Inside bar 37, but probably sellers above. We're at resistance, and 36 proved that to us. Failed breakout above yesterday's high. We're testing yesterday's high a couple times again. So we tried to break out once and failed. 36 tried again and failed. Whenever the market tries to do something twice and fails, it often tries to do the opposite. And then outside down 38. Another one of those bars that's air quote surprising, but the reality is there's probably sellers above 37, and now 38 is more of a give up bar where the last of the bulls have given up on the long. It turns out it looks like we're high in a trading range, and this was probably an exhaustion gap. We'll probably test the low of the bar and the breakout point. 39, you can see we went straight to the low of the bar, so bear breakout, follow through. But this had a lot of overlap with the prior bars. 39 is better. It's getting further consecutive bear bars, but we still tested the breakout point 37, overlaps with no micro gap here, but strong enough down, it'll probably get a second leg. So probably going at least a little lower. And then bar 40, more follow through. So bear breakout, crossing the moving average, actually crossing both moving averages. Strong enough, it's probably a leg 1 breakout, a leg count reset. Maybe this was a trading range, and we got a breakout. So any pullback will likely lead to a second leg down. What about selling the close of bar 40? There's an increased risk of selling the close of 40 for a couple of reasons. Some computers probably see this as 2 legs down to 35, pullback, second leg. Plus, you look to the left at the context, we're testing breakout points. Bears got trapped selling above here. That's where we're testing. This was strong enough for a second leg, but it was a second leg trap. We're expecting a deep pullback. This might be that deep pullback. But again, the reality, if you're buying against 3 decent bear bars, and this is probably going to get a second leg. Inside bull trend bar, 41, but inside bar, so trading range bar, completely below the 5-minute EMA, probably sellers above and a second leg down, but strong enough bar might go a little higher. 42, it's continuation and consecutive bull bars, probably buyers below 42. It's a weak low 1 short. 43 triggered the low 1 short and failed. Bad stop order means good limit order, but if it's a limit order trade, after this, the bulls are taking that for a scalp, so they buy below 42 and they scalp on 43. Probably sellers above 43. It's a bad high 1, and we're expecting a second leg down after this. 44, bear breakout and testing the close of bar 40, where bears who sold the close got trapped, scaled in lower, and they're exiting. Is 44 the second leg down? I don't know. It's similar to right over here, where here's 1 leg down, then a pullback, and then is that the second leg? Well, I mentioned the market likes symmetry, and so that's my problem with this being the second leg over here. Fairly big breakout, pullback. You can argue minimum second leg. If this happens to rally, we will look back and say the bears had their minimum second leg, just like over here. If this rallied, we would say 14 was the minimum second leg. But the reality is we're probably going to get a more symmetrical second leg. This happens all the time. And what's the bull argument? Are you eager to buy above bar 44? Probably not, because you're still expecting sellers above after a breakout like this with, let's see, that's yesterday's high. I don't want to take that. But this one, and I'll change the color. We have a breakout point below 35. Bulls buy below. This is a trading range. Bulls buy below. They get trapped. They'll probably be able to avoid a loss if they scale in lower and look to exit at their break-even entry. And then 44 is a bad buy signal bar. So for a couple of reasons, probably more sellers above 44. And then bar 45 was a surprise bar. And as strong as bar 45 is, it's a really decent bull trend bar closing near its high. You got to ask yourself what the context is here. It's possible we have a bear breakout, a 2-legged pullback, and even a smaller version of this. I mentioned second leg trap. There's a couple ways to look at it. Maybe this is leg 1, 2-legged pullback. All of this is leg 2 to the top of the trading range. And that's similar to 45. Bear breakout point here, trapped. Bulls are trapped here, buying below. And then leg 1, pullback, leg 2. So you might have more traders selling the close of 45. You have bears selling to initiate shorts, betting on a second leg down. And you have bulls who bought the breakout or bought below 35, which became a breakout point. They got trapped and they scale in and they're looking to exit around here as well. So that's bulls and bears both selling. And that's what happened on 46. But all of this was damaging to the bear case. This was a lot of sideways, and the bulls were able to move the market a fair distance. And so this is probably a trading range. This is a big bear trend bar, and that's great. But now we have 2 legs down, and we're testing support. You look to the left, and this is an area where bears got trapped. So that's the problem with selling a bar like 46. It's so frustrating thinking back when you're starting out and you see all these trend bars, and I've probably been the guy that bought bar 45 and then I saw bar 46 and then I reversed on the close of 46, and it's just the exact opposite of what you need to be doing in trading ranges. But that is something, you make these mistakes, and as long as you're journaling what you do, you start to catch on that it's buy low, sell high, scalp. You see trend bars in the trading range, probably do the opposite, if anything. 47, the bears got minimum follow through, the absence of a bull body. So bear breakout 46, follow through 47, but it's a trading range bar. It pulled back a fair amount. Bulls that bought below 45, almost able to avoid a loss. So not ideal for the bears. Already mentioned 2 legs down, testing support. So we might bounce here. Probably buyers below the trading range bar 47. 48 an inside bar, I think. Double check that. Yes, they have the same high. So 48 is an inside bar. It's a bull bar. Closing on its high, maybe 2 or 3 legs down, and then a bull bar closing on its high. Some traders might buy looking for a swing, but the reality is, in this type of context, if you are buying, you have to understand what your expectation is. And if you're buying thinking we have a wedge, expect 10 bars and 2 legs sideways to up. That means you're expecting 10 bars and 2 legs sideways to up. You're not expecting a bar like bar 29 on bar 49 to just rally all the way up to the high of the day. It's an inside bar, so it reduces the probability for breakouts. So there actually might be more sellers above. 46 was strong enough for a second leg, and then 48 is completely below the moving average. So you will have limit order bears selling above the trading range bar and above 48. 49, so bull. I say bull breakout, even though it's an inside bar, and inside bars are the only non-breakout bars. But bull trend bar 48 and then follow through 49, but still completely below the moving average. Maybe it's 3 legs up. We rallied on 47, sold off, rallied on 48, sold off on 49, rallied on 49. That's 1, 2, 3. After a bear breakout, testing the moving average, you might have to sell off a little bit. And that's what happened on 50. 50 sold off, I should have mentioned, bad low 1 short below 49, 3-bar micro channel, consecutive bull bars closing on their high, and a late leg. This is leg 2 or 3. So probably buyers below the low 1, and that's what happened on 50. 50 is a high one, but a trading range bar, more likely sellers above, and overall sideways, probably buyers below. Inside bar 51, you can again call it a high 1, but we're staying below the moving average. But the reality is, if you look at the moving average, you look at the bars are all overlapping and going sideways. So in this context, buy low and sell high. We triggered the buy above 51, the high 1, which was bad, which means it's a good limit order trade. So we triggered above bar 51 and then sold off. Bear bar 52, but I mentioned we might already have 3 legs down, if not 2 legs down in the trading range, testing support. So the downside here might be limited. 53 trading range bar, we sold off below 52, but was disappointing. It was a failed bear breakout, probably buyers below. And what about buying above? It's not ideal. There's a lot of trading range price action, but we may have to come back up and test the bar 45 close where bulls got trapped. And then 54 rallied, and you can exactly where it rallied to. I have this drawn, the breakout point, but if I put it on the close of 45, that's exactly where 54 tested. So now at this point, we have two legs up, rallied up to 50, pulled back, went sideways, rallied on 54, testing resistance. Why is this line resistance? Why is the close of 45 resistance? Because if you're a bull and you bought the close of 45, you got 46, you're obviously disappointed. So you scale in lower. And if it gets back to your entry price, you're going to take that as a gift and basically just exit your position. And that's what happened on 55. Bear bar, maybe a low 2, maybe a low 3, low 1 below 49, low 2 below 53, and then low 3 below 54 or 55. But it's a trading range. There's probably buyers below. This is the middle of the range. Sellers above 55. Inside bar. So consecutive inside bars on 56. Breakout mode. I draw triangles all the time. That's what we have here. The market is getting squeezed, and eventually we'll have a breakout. And remember, 50% of breakouts of triangles are the wrong direction first. So if we have a bull breakout, maybe we just test resistance and reverse back down. If a bear breakout, maybe we test support and reverse back up. This area it's an area of agreement. The market's sideways. Bulls and bears are initiating trades. It's confusing. More sideways on 57. I think that's 3 consecutive inside bars. So the market's getting very squeezed. And if you looked at these since bar 54 on a lower time frame, you'd see a triangle on there. So it's really a nested triangle pattern. All that means is the market is in breakout mode. It's really sideways. So better to wait for a breakout. If you are trading, it's a limit order market. You're selling above bars and buying below. Bull breakout attempt 58, but very weak and a small bar. Bad signal bar, so probably buyers below 58. And then outside up 59. Bull breakout attempt, trying to get above the triangle. That might be one close above. The bulls want follow through. But now we're high in a trading range. You can argue the high of the trading range is up here. And we may have to get up there before the bears look to initiate shorts again. And then 60, we went more sideways. It's a breakout attempt of a triangle, and the bulls did not get follow through. It failed. So going more sideways here, probably sellers above 60 and buyers below. Inside bar, 61. Again, we're just going more sideways, consecutive inside bars. The market's getting squeezed, and eventually one side will give up. But it's so tight, such a tight trading range, and you can see the moving averages, both are completely flat. Market's in balance here. Bear breakout attempt, 62, but bad context. You're in a tight trading range. And then it immediately reversed, 63. What about buying above 63? Some traders might, betting, let's see. Here's the triangle. We got a bear breakout attempt. It failed, and we're going to get the reversal in a bull breakout. And it's possible, but you have to understand what your premise is and what you're going for if you're buying above 63. And even if we get a bull bar closing all the way up here, you look to the left, you're still in a trading range. So the reality is, if bulls are buying above 63, they're probably scalping. And then 64 did just that. We have a test of the high of this range, just getting above 45. But what happened the last time the market was at this price? It sold off pretty strongly. So as far as being long here, it's not ideal. Isn't it consecutive bull bars? At least one being big and both closing near their high. Is it always in long? When you use that definition for always in long, yeah, but always in long, a trading range then means you look to sell. As soon as it becomes clearly bullish, that's when everybody looks to sell. And the opposite's true for the bears. It looks clearly bearish. 4-bar micro channel, consecutive bear bars, everybody buys. And then there's these big bear bars, and they get bad follow through. Micro channel, and we bounce. So the same probably applies here. Consecutive bull bars, and they're pretty strong, but bad context, so probably sellers above. And then inside bar 65, disappointing for the bulls. Might get a small second leg before a reversal, but if you are buying for a second leg, that is, you're looking for a minor second leg for the bulls, leg 1, leg 2, it can be dangerous if you scale in. 63 or 66, consecutive bear bars, a bear trend bar crossing the moving average, but the reality is we're mostly sideways. We're probably just testing lower, and you're going to find buyers somewhere below, maybe below 63, maybe down here. And then 67 sold off a little further. At this point, it might be a contracting triangle into an expanding triangle. And again, all that means is the market's in breakout mode. It's probing up and down, searching for a fair price. Eventually it will break out, but it can go sideways for a lot of bars. So that's the problem with being short here, below 63 on 67. What about buying above 67? Not ideal. 3 bars down in a weak buy signal bar. There might be more sellers above, but it's the middle of a tight trading range. Not ideal to do anything. Going a little lower with an inside bar on 68, but it's an inside bar, low in a trading range, probably buyers below. Kind of similar to, reminds me of yesterday over here. Overall trading range, tight channel, low 1 below 41, but there's probably buyers below. And that's where we are here. 69, we had more sellers below. We actually had a successful breakout, closing below the low of the prior bar, but still within the range of 67. So we still don't have a breakout. And even if we did, we'd have to worry about buyers below 47 in overall trading range. What might be happening is maybe all the way down to 47 was one leg for the bears. Hard to see on this chart if you just look at maybe some higher time frame. I don't know, maybe 30-minute chart, 45-minute chart. It's just a couple bars down, and then you get a pullback and then a second leg. We're testing an area where bears got trapped. This is an area of support. Plus the expanding triangle support as well. 70, it's a bull bar, and we triggered above 69, which was a weak buy signal bar, but the context is okay because we're low in a trading range. And then there were probably buyers below 70, did not trigger. 71 going higher. Consecutive bull bars. It's a problem for the bears because this might be an expanding triangle, and the bears realizing they may have just been trapped. 72, 3 consecutive bull bars. That's a problem for the bears. The bears hoping this was strong enough that this is just a pullback before a second leg down. But the reality is this was strong enough for a second leg. This may have been a complex 2-legged pullback, and this may be a second leg. And then 73, this is becoming an endless pullback for the bears after this micro channel. Yes, it was a micro channel, but it was a nested couple of legs down to 67, pullback, and then second leg to 69, or leg 1, leg 2. Just look at the area that we're in every time the market's been at this price since here or here. We rallied, and we rallied again. 74, another bull bar, so that's 5 consecutive bull bars, probably buyers below. And I know it's a little unfair because I know what happened today, but the reality is it's similar to over here. It's a little bit of an endless pullback. You have this rally and you're expecting a second leg, but you get 1, 2, 3, 4, 5, 6 bars against you. That becomes really disappointing, and eventually, in this case, we had the retest before the sell-off, but this is the give up by the bulls. And then in this case, this is an endless pullback. So here's the bears getting trapped, and we're expecting a give up in a rally. 75 bull bar closing on its high. That's 6 consecutive bull bars. And if you're a bear, that's not what you wanted to see. Can you argue we're high in a trading range? You can. And what's the difference between this sell-off and this rally? Well, there's a couple things. It's like I mentioned over here, the higher time frame. Here's a big rally, and then this was more sideways, more of a pullback after this rally. We still had support below, and we're expecting a second leg, which we haven't got yet. Because again, was this leg 1, pullback, leg 2? Probably not. It's just like this one, leg 1, leg 2, and this one, leg 1, leg 2. Those second legs are minor, and you end up getting a bigger symmetrical second leg leg 1, leg 2, and same thing here, leg 1, leg 2. So my concern with selling here is that we have leg 1, leg 2. 76 bear bar, but micro channel, probably buyers below the first pullback. So bulls probably buying here, buying the moving average, expecting a second leg up. And then obviously the surprise bar, 77. Breaking out above the hive yesterday once again. But look at the context. It's a trading range. And it's just like if you're buying bar 29. It's not what you want to do. It's not ideal. Enough momentum. It'll probably get a small second leg. And then 78. Instead, we rallied on 78. And then 78 was a disappointing bar for the bulls. We're at yesterday's high. We're high in a trading range. If you get a bar like 78, it's probably better to exit longs, but it's definitely aggressive to be selling. But when you see this, again, you look at this and you know the market's in a trading range. And when the market's in a trading range and you get open gaps, here's a breakout point. Bears betting this was a bad buy signal bar. This should be high in a trading range. They sell here. They did something reasonable. There's an argument to be made for that. Then they get this big breakout against them, but the market's overall in a trading range. This gap will probably close, if not today, then probably tomorrow. But it ended up closing on the next bar. 79 sold all the way off. Big up, big down, big confusion, trading range, price action. Late in the day, hard to do anything here. And then 80 inside bar, probably going more sideways into the close, and then just a little more down on 81. For always in today. Always tough with trading range days, but you have to think about context more than the bars themselves. And so that's why at this point today, and again, I will mention one more time, I thought using Globex was useful on the open because you know what this rally on the open is going up against. But even if you don't have that, you have the gap down, we're high in a trading range. Probably always in short, believe it or not. And here, by this point, because you have 1, 2, 3, 4 pushes up, really weak rally, probably a leg in a trading range at resistance. And then down here, 2 legs down, 3 pushes down, low in a trading range. You're probably always in long by here. And then that's confirmed. And then it's probably still always in long until 29. You get 29, that's a bar that bulls look to take profits on. It's a profit maximizing bar. So it's not that it's always in short on the close exactly, but you got disappointing bar 30, 31. At some point, it becomes an endless pullback. And then here, you know, we're probably going lower. The bulls just gave up. Bear breakout, but the problem with breakouts and always in trading ranges is that it's kind of opposite. Looks strongly bearish, but testing support to the left. So probably if it's always in short, you're probably getting fooled because it's a trading range. So you want to do the opposite. And then same thing with these bars. Strong bull bar, but you want to sell. Strong bear bar, but you want to buy. You're low in the range. And then really sideways in here. Hard to call it for always in. Same thing here. Consecutive bull bars, but probably want to sell. Consecutive bear bars, but probably look to start buying. Here, this one's a little different because of the context. And this is very uniform by the bulls. Over here, it's more of a bear bar, sell climax, pullback, more overlap. Not that these bars aren't overlapping, but the way they're moving, there's no big climax. And the bars are really similar in size. And that's about it for always in. For stop order trades today, I thought you could sell below bar 10, maybe use a wide stop. It's not the greatest signal bar, but it's more about the context there. So same with 11, you could sell below these bars. The market will sweep you in. I thought you could sell below 18. It's a pullback after this breakout, expecting a second leg down. I thought you could buy above bar 22, double bottom, and possible wedge bull flag. And it tested that breakout point, bar 43 from the prior day. You could probably buy above 26, 27, 28, and then 29 is not a buy. It's more of a profit-taking bar. Stop order sell below maybe 39, 38, maybe a little early. You have a lot of trading range price action, but then bear breakout. Follow through, crossing the moving average might be okay. And then hard to sell with a stop order in here for this second leg unless you go to a smaller time frame. I thought 48 was a reasonable stop order trade, but lots of two-sided trading. You can see the market went very sideways. And then maybe buy above 63, but have to be quick to manage it. You get 64, and that's great, but you still need one more bar, and they don't get it. And then maybe sellers below 65, but also looking for a scalp. You get low in the range, you look to buy. 70 might be hard to buy after a micro channel, but low in the trading range. Okay context. Maybe you get 2-3 consecutive bars, maybe 4. You start to buy there. And then I think it's aggressive, but okay to sell below 78, but not exactly an ideal trade. Limit orders today. One of the best ways to look at limit orders is to think about the stop order trade. Is it a good stop order to sell below 5? Probably not, so buyers below. Good stop order below 8? Probably not, buyers below. Good stop order 10? Now I'm contradicting myself because I would, personally, if I had to choose, I'd rather sell below bar 10 than buy below. Because of the context, I am expecting some sort of sell-off and even a test of the low of bar 1. But the reality is it's a bull channel and it's a trading range bar, so you will have buyers below for a scalp below bar 10. We had this big breakout, probably sellers above 13, maybe getting filled here, or sellers at breakout points getting filled over here. I don't think 21 is a great limit order trade because you're low in the range. The context is bad, and if you did take it, you probably exit above 22. And then bad low 1 below 24. It's a minor reversal, breakout, pullback. You can buy below 24. Plus it's an inside bar. So even though it's a bear trend bar, it's an inside bar, so it reduces the probability. And the context, again, is bad. We're just above this breakout point. You did have bulls buying below here, looking for a second leg, and they scalped. They got it. And then 37, inside bar, but high 1 after an endless pullback and disappointed bulls. You can sell above 37. Tight enough down for a second leg, but not ideal to sell above a bar like 41 with breakout point all the way up here. Maybe you sell above 42 or 44. It's a bad micro double bottom with a weak signal bar, so probably more sellers above 44. But the market's in a trading range here, so you have buyers down here at the new low. So the bears get their second leg, they scalp out, and you have bulls buying, breakout points to the left. That's what happened on 47. 49, again, think about, is this a good stop order? Low 1 short after a late leg, consecutive bull bars? Of course not. Probably buyers below 49. And same with here. Low 2, but terrible context. Probably buyers below. Really tight trading range all through here. Buyers below bars, sellers above bars. And then here, again, another bad stop order trade. Buyers below 75. Buyers below any of these bars. Micro channel, but did not trigger. And then maybe you make an argument. I talked about this though. The context really wasn't great. And then you could probably sell the high of the day, but there's a lot of momentum, and it's sort of the catching a falling knife analogy. You never know how far it's going to go. So you need to use a wide stop and scale in. And then big enough breakout here, buyers below the bar, scale in, and then you'd make a profit there as well. Where do we go tomorrow? We'll look at the daily chart. It's helpful to look at the 5-minute intraday chart as well. You know the market's in a trading range in here. And so we just triggered a high 1, but we're probably in a trading range. Probably more sellers above yesterday's high and buyers below. It's a bad low 1. But it's also not ideal to be buying here. And again, I just want to show the 5-minute chart and look at the past few days. And it doesn't get much more sideways than this. So the odds that tomorrow is just some big bull trend day or big bear trend day is really low. So my expectation for tomorrow is really just more of the same, more sideways. And as always, please feel free to leave questions in the comments and include the timestamps for any question specific to this video. Alright, hope everyone has a good rest of their night. Thanks for watching.